Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Just ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
In this lesson here in chapter 6, we're going to go over how to calculate your position size for a trade. And then we'll run through an actual example of a trade to see exactly how this should work in theory. All right, so no matter how big your portfolio is, you'll need to exercise proper risk management. I mean, otherwise you may quickly blow up your account and suffer some considerable losses. And a lot of traders that have been here for a while have been through this, unfortunately. Now, weeks or even months of progress can be wiped out by a single poorly managed trade. Let me say that again, okay? Weeks or even months of progress can be wiped out by a single poorly managed trade. All right, so it's always important to stay on top of your game, keep your attention to detail at the highest level possible, and never sacrifice your trading plan criteria for anything. Do not move your stop loss once you enter into a trade. That trade idea should be set in stone. Okay, so a fundamental goal when it comes to trading or investing is really to avoid making emotional decisions. As we mentioned many times so far in this entire course, never trade on hope, never trade on emotion, and never trade on intuition, especially if you're a new trader. So as financial risk is involved with trading, emotions will play a huge part. You'll need to be able to keep them in check so they don't affect your trading and investment decisions. This is why it's useful to come up with a set of rules that you can follow during your investment and trading activities. Let's call these sets of rules your trading system. The purpose of this system is to manage risk, but equally as important is to help you eliminate unnecessary decisions. This way, when the time comes, your trading system won't allow you to make hasty and/or impulsive decisions. Now, when you're establishing these systems, you'll need to consider a few things. One, what's your investment horizon? Meaning, how long do you expect it to take to reach your goals? What's your risk tolerance? How much capital can you risk? We can think of many others, but in this lesson, we're really just going to focus on this specific aspect of calculating your position size for individual trades. All right, so but before we do that, we'll need to determine how big your trading account is and how much of it you're willing to risk on a single trade. Okay, so how to determine your account size? Well, while this might seem extraordinarily simple and redundant, it's a valid consideration. Now, especially when you're a beginner, it may help to allocate certain parts of your portfolio to different strategies. This way, you can more accurately track the progress you're making with different strategies and also reduce the chance of risking too much and losing it all. For example, let's say you believe in the future of Bitcoin and you have a long-term position tucked away on your hardware wallet. It's probably best to not count that as part of your trading capital. Keep that tucked away, do not touch it. In this way, determining the account size is simply looking at the available capital that you can allocate to a particular trading strategy. Remember, do not move anything to an exchange that you're not willing to lose, because it is very possible that you may lose it. Even if your trading strategy is sound, there are some security protocols that you should implement, especially considering the unregulated nature of cryptocurrency trading. Okay, so next we're going to go over how to determine your account risk. This is really the second step in your trading system, and we're going to try to figure out how much you should really risk on a single trade, and this will be dependent on your risk tolerance. So a good rule of thumb to follow is the 2% rule. Now, traditionally, there's an investing strategy called the 2% rule. According to this rule, a trader shouldn't risk more than 2% of their trading account in a single trade. We'll go over what that means exactly, but first, let's adjust it to be more suitable for cryptocurrency. The 2% rule is a strategy suitable for investment styles that typically involve entering only a few trades per year, swing trades, and longer-term positions. Also, this is typically tailored to less volatile trading instruments or financial instruments than crypto. Now, if you're a more active trader, and especially if you're just starting out, it could be life-saving to be even more conservative than this 2% rule. In this case, it's highly recommended to use the 1% rule instead. This rule dictates that you shouldn't risk more than 1% of your trading accounts in a single trade. Now, that's not 1% of your total crypto holdings, that's 1% of your trading accounts. Now, does this mean that you only enter trades with 1% of your available capital? No, absolutely not. It only means that if your trade idea is wrong and your stop loss is hit, you will only lose 1% of your account. So let's go over how to determine your trade risk. So far we've determined that our account size and our account risk. So how do we determine the position size for a single trade? Well, we look at where our trade idea is invalidated. Okay, so this is a crucial consideration and applies to almost every single strategy. When it comes to trading and investing, losses will always be a part of the game. And as a matter of fact, they're a certainty. These are a game of probabilities. Everything about trading is simply a game of probabilities and trying to find the forecast or idea that has the highest probability of working out. Now, not even the best traders are always right. Actually, some of the best traders are wrong much more than they are right, but they are still profitable. And you might ask, how is this possible? Well, it all comes down to the ever important risk management, having a strategy and sticking to it. Now, such traders must have an idea of their invalidation points. This is where we say, and quote, "Our initial idea was wrong, and we should get out of this position to mitigate further losses." Now, on a more practical level, this just means where we place our stop loss order, and if price happens to come down and hit that order, then our idea is invalidated, and we are looking for the potential next trade. Now, the way to determine this point, or this invalidation point, or where to put your stop loss, is really entirely based on the individual trading strategy and the specific setup. The invalidation point can be based on technical parameters such as support and resistance, or it can also be based on indicators, a break in market structure, or something else entirely. It really depends on your trading strategy and your technical analysis skills. Now, this is not a one-size-fits-all approach to determining your stop loss. You'll have to decide this yourself, and you're also going to have to decide what strategy fits your trading style, your personality, and it's best to determine the invalidation point based off of that. All right, so how do we calculate our position size? So now that we have all the ingredients we need to calculate position size, let's say we have a $5,000 account. We've established that we're not risking more than 1% on a single trade. That means we cannot lose more than $50 on a single trade. So let's say we've done our analysis of the market and have determined that our trade idea is invalidated 5% from our initial entry. In effect, when the market goes against us by 5%, we exit the trade and take our $50 loss. In other words, 5% of our position should be 1% of our account. So for example, you have an account size of $5,000. You only want to risk 1% of your account, and your invalidation point is 5% below your entry point. Okay, so the formula for calculating this is your position size equals your account size times your risk divided by your invalidation point. All right, so the position size for this trade will be $1,000. Now you might say, that's not 1% of my account. No, but we're setting up the trade so that if the trade is a loss, then you will only lose 1% of your account. Now, by following this strategy and exiting at the invalidation point, you might mitigate a much larger potential loss. And to properly exercise this model, you'll also need to take into account the fees you are going to pay. Also, you should think about potential slippage, especially if you're trading in a lower liquidity crypto or stock or financial instrument, anything of the sorts. Now, to illustrate how this works, let's increase our invalidation point to 10% with everything else being the same. Okay, so the same formula, position size equals 5,000 times 0.01, which is a percent, divided by 0.1. Okay, so our stop loss is now twice the distance from our initial entry. So if we want to risk the same dollar amount for that trade, the position size we can take is actually cut in half. So instead of $1,000, we will only risk 500. All right, so now that we know how to calculate our position size according to our trade setup, in the next lesson, we're going to go ahead and put it all together. So before moving on, a good idea would be to go ahead and download this file. You can use it as a Microsoft Excel sheet, or you can just put it into your Google Drive and open it as a Google Sheets document. This has everything from trying to calculate your return on investment according to your trading plan. It has some tools to use to monitor your trading progress, your risk reward ratio calculator for each trade that you can use, and also a handy dandy position size calculator. And then at the end here, you have it broken down into 4 quarters of the year and specific entry points for each specific trade. That way you can go back test your strategy, review your success and or failures, and improve on your trading strategy. But with all that said, let's get into the next lesson.